It was looking like a smooth recovery, a successful leadership transition, a stock market bounce in the fourth quarter, and a renewed jump in exports. But now some worrying signs. A fresh survey in China shows corporate sentiment has weakened. In fact, the index for China has matched its all-time low, while sentiment overall in Asia has ticked up. Antonio Fatas of INSEAD.
China is a very interesting country that has been doing extremely well now over several decades. And I think there are some questions about how sustainable that growth will be. There are increasing questions about the potential, either a credit crisis, a financial crisis, a real estate crisis. So I think we're going to see this as a recurrent phenomenon.
The latest set of Chinese corporate earnings have been disappointing. Nearly three-quarters of China companies which have reported for 2012 have missed estimates. Consumer brand Tingyi earlier this week posted a 75% drop in fourth quarter earnings, while electronics maker Sunning's profits nearly halved for 2012.
We do think that China is the bigger uncertainty. Now, that doesn't necessarily mean that China becomes a bigger negative, but in terms of what markets at this point I think can safely bake in to equity valuations, China is the one that still at this point is probably the least clear.
Another rising bugbear for China corporations, inflation, which hit a 10-month high in February, and China's central bank governor said he would remain on alert. This means companies could face rising borrowing costs in addition to souring consumer confidence. So while official data indicates China's economy is gaining strength, the companies on the front line seem unconvinced, and that means the country's rebound may be on thin foundations.